Open a price chart, and it looks chaotic, just squiggles everywhere. But there's a simple tool to bring order, the trend line. It's a straight line you draw to see if the market's moving up, down, or sideways. Why care? Because trading with the trend is like swimming with the current. It makes everything easier. A trend line helps you spot the market's direction and potential buy or sell zones at a glance. It cuts through the noise, focusing your attention on price action, not opinions. It's not a magic predictor, but it's a powerful guide to help you trade with confidence. Mastering trend lines is your first step to becoming a systematic trader. How do you spot trends in the market? Identifying these patterns is crucial for making informed trading decisions. It's all about recognizing the pattern of highs and lows that the market creates over time. These patterns tell a story about the prevailing sentiment. An uptrend is characterized by a series of higher highs and, crucially, higher lows. Each successive peak and trough surpasses the previous one, like walking up a staircase where each step takes you higher than the last. This indicates sustained buying pressure. A downtrend, naturally, is the opposite scenario. It signals a period of consistent selling. Lower lows and lower highs like walking downstairs. Each step descends further than the one before, reflecting bearish market conditions. Don't expect perfect patterns in the real world. Market behavior is rarely textbook. Markets are messy, influenced by countless factors and often exhibiting unpredictable volatility. To get a clearer picture, zoom out and look for the overall direction of the price movement. This helps filter out short-term noise. Climbing from bottom left to top right on the chart is a telltale sign of an uptrend, indicating a bullish market sentiment. Conversely, a movement from top left to bottom right is a downtrend, suggesting a bearish market. Ignore minor fluctuations. These are often just temporary reactions to news or events. Focus on the big picture, the overarching trend that defines the market's direction over a longer period. Practice by opening any chart you can find, whether it's stocks, commodities, or currencies, and marking periods of clear uptrends and downtrends. Draw lines connecting the highs and lows to visualize the trend. The more you do this simple exercise, the more familiar you become with different market patterns. The faster you'll spot trends and make quicker, more confident decisions in your trading. It's not about complex analysis or using sophisticated indicators. Just training your eyes to recognize basic patterns and understand the language of the market. This simple exercise builds your chart reading skills fast, giving you a solid foundation for more advanced analysis later on. Once you spot a trend, identifying whether it's an upward or downward movement, it's time to draw your trend line. This line will act as a visual representation of the trend, helping you to analyze price movements and make informed trading decisions. Think of it as a roadmap for understanding where the price might be headed. For an uptrend where the price is generally moving higher over time, connect at least two significant swing lows. These swing lows represent points where the price dipped temporarily before resuming its upward trajectory. Those valley points where price bounces higher. These points often act as support levels, preventing the price from falling further. Use your chart tool, connect the lows, ensuring the line slopes upwards, and extend the line into the future. This extended line can then act as a potential support level, giving you an idea of where the price might find support in the future. For a downtrend where the price is generally declining, connect at least two swing highs. These swing highs are the peaks the price reaches before reversing downwards. The peaks before price drops. These peaks often represent resistance levels, where the price struggles to break higher. Extend the line out. It acts as resistance, potentially preventing the price from moving above it. Use the wicks of candles for more accurate lines, as they represent the extreme price points reached during a specific period, but be consistent. Choose whether you're using candle bodies or wicks and stick to it. Don't force the line. Let the price action guide you. If it doesn't fit, if the line doesn't naturally connect the swing highs or lows, the trend may not be valid, or you may be looking at the wrong time frame. Aim for a line of best fit, not perfection. Trend lines are not exact sciences, but rather tools to help you understand the overall direction of the price. As price touches your line more times, reacting to it as either support or resistance, its validity increases, strengthening the signal. Practice drawing trend lines until it feels natural. The more you practice, the better you'll become at identifying trends and drawing accurate and useful trend lines. Not all trend lines are equal. Some are strong, others weak. The more times price touches your line and bounces, the stronger it is. 3 or more touches make a trend line significant. Watch the angle. Very steep lines usually break quickly, moderate angles are more sustainable. Longer trend lines that span months are more important than short-term ones. When a long-term trend line breaks, it's a big deal. Look for strong bounces off the line. Weak reactions mean the trend may be fading. If price hugs the line or bounces get smaller, momentum is weakening. Always consider the time frame. Longer trends matter more. Reliable trend lines help you make better trading decisions. Let's delve into the practical application of trend lines and explore how they can be effectively used in real-world trading scenarios. We'll break down specific strategies and techniques to help you integrate trend lines into your trading decisions. In an established uptrend, a key strategy is to identify buying opportunities when the price retraces or pulls back to the trend line, which now acts as a dynamic support level. This pullback represents a potential area of value. For added confirmation, look for the price to show a bullish signal, such as a bullish candlestick pattern forming right at the trend line. This indicates that buyers are stepping in and rejecting lower prices. Prudent risk management dictates that you place your stop-loss order just below the trend line. This placement protects your capital if the price unexpectedly breaks below the trend line. If the price decisively breaks below the trend line, it signals that the uptrend may be weakening or reversing, and your initial trade idea is likely invalidated. It's time to exit the trade. When it comes to taking profits, a common approach is to target new swing highs as potential exit points. These represent areas where the price has previously encountered resistance. Alternatively, you can implement a trailing stop-loss strategy, continuously adjusting your stop-loss order just below the rising trend line as the price moves higher. This allows you to capture more profit while still protecting your downside. Conversely, in a downtrend, the strategy is to look for selling opportunities when the price rallies or bounces up to the trend line, which now acts as a dynamic resistance level. In this scenario, you would place your stop-loss order just above the downtrend line to limit potential losses if the price breaks above it. It's crucial to remember that trend lines are not precise, unwavering lines, but rather represent zones or areas of potential support or resistance. Treat them as flexible guidelines. Therefore, don't expect the price to always reverse direction perfectly at the trend line. There will be instances of slight overshoots or undershoots. Always wait for confirmation signals before entering a trade. Look for a strong candlestick pattern or other technical indicator that confirms the presence of buyers or sellers at the trend line, indicating a high probability of a reversal. Avoid placing blind orders based solely on the expectation that the price will automatically reverse at the trend line. Instead, allow the market to confirm your trading idea by providing clear evidence of a potential reversal or continuation of the trend. Exercising this patience and discipline will significantly reduce your exposure to false signals and whipsaws, which can lead to unnecessary losses. Ultimately, trend lines provide a valuable framework for structuring your trading plan, offering clear guidelines for entries, exits, and effective risk management. Let's recap the essentials. Trend lines show market direction. Uptrends connect lows, downtrends connect highs. Strong trend lines have multiple touches, a reasonable angle, and last longer. Use them to find high-probability trades and set logical stop-losses. Mastering trend lines is a skill practice is key. Draw lines on different charts and time frames, see which ones hold and which break. Don't get discouraged by mistakes, no tool works every time. Your job is to put the odds in your favor, not to be perfect. Trading with the trend already puts you ahead of most beginners. Keep practicing, stay curious, and go draw some lines.